Eddie Lampert, who is Land's End's largest shareholder, owning 55% of the company. This is a piece that he inherited after, I don't know, we could call it the Sears debacle, has asked the management and board of the company to explore a strategic sale. We're going to talk about that, a couple other things, and wait on NVIDIA earnings today on Open Interest. Hello, everybody, and welcome. I'm Mike O. Welcome to Open Mike, where we talk about stocks, options, and I take your questions. So we got news yesterday. Eddie Lampert, who has ESL Investments, it's a trust. He was a big investor in Sears, among other things. He filed a letter and sent it into the management of Land's End. This is a small company, and he was interested in exploring a sale. Not surprising, given that stock's pretty miserable performance. This is not the kind of stock we would usually talk about, but one of the reasons we are going to talk about it, despite the fact that it's really a micro-cap company, I think at this point is valued in just a few $100 million, was that while I was doing that, it got me looking once again at some other apparel companies, including some that we've talked about in the past. And so before we get to the Estee Lauder thing, I wanted to just highlight, and maybe we can show my screen right now, and one of the things you're going to be seeing here is the performance of the S&P, that is the white line here, over the last couple of days. And the blue and the orange lines are the performance of Estee Lauder here in blue, and Nike here in orange. And it struck me, this struck me as being very funny that these two stocks in particular would rally so strongly even as the market was rolling over. So much so that it actually reminded me of a Geico commercial, and I think we have that. So we're going to run that now, and we'll talk about what we're looking at.
Let's hide in the attic.
No, in the basement. Why can't we just get in the running car?
Are you crazy? Let's hide behind the chainsaws.
Smart. Yeah, okay.
If you're in a horror movie, you make poor decisions. That's what you do.
When you're in a horror movie, you make bad decisions. That's what you do. It struck me as really rather interesting that as the S&P sold off, Estee Lauder and Nike would start to rally. Now, look, in fairness, I think Bill Ackman has announced that he has a position in Nike now, and who am I really to knock Bill Ackman? He has a stellar investment track record. He is one of the few hedge funds that has managed to meaningfully beat the S&P over an extended period. But it strikes me as odd because Nike is still trading at around 32 times forward earnings. Now, there's an analyst over at Jefferies. He's got a buy on Nike, and we've previously discussed the relationship between Nike and LULU, a pairs trade that I had recommended a while back. Basically, the idea was that Nike's top line was declining, their earnings were declining, they were trading at big turns to their forward earnings estimates. It is right now, I think, trading around 32 times forward. And meanwhile, LULU, which was still growing the top line, albeit less quickly than they had been, but high single digits, high single to low double-digit earnings growth, was trading at 21 or 22 times. And this struck me as very perplexing. We talked about a similar relationship between Elf Beauty and Estee Lauder. And Estee Lauder also, continues to be under some, meaningful pressure. And yet it seems like this was where people were deciding to deploy their capital as the market rolled over. And I was just sort of thinking to myself, did they believe that this was a flight to quality, a flight to safety, to go into companies that are trying or attempting to be some form of, some form of a better place to be when the market is under duress? I don't think so. Now, let's just take a look instead of at LULU, another name that was brought to my attention, which they own Hoka, which is Deckers. So this is another interesting one where you've got a situation. Stock has performed very badly off the heels of their recent earnings. And I'm not saying that this looks like a great chart technically, but when we take a look at this thing from a fundamental standpoint, you know, we have what looks like it might be an unfilled gap here, perhaps and another one back here. But just a quick point I would like to bring up, which is that, let's see here, we have, looks like we got some results out of NVIDIA, so I might as well just restore, yeah, NVIDIA preliminary. So Q4, 89 cents versus 85-cent FactSet consensus. Revenues of 39.33 billion versus 38.10. Again, those are the FactSet consensus numbers. So a 4-cent beat and a revenue beat of 1.2 billion. Yeah, this is not terribly surprising. You know, when you talk to the hyperscalers and everybody else, they did not indicate that they were slowing their spend. I think that the question that we're going to wait on, and I'm going to ask if someone can give me an update, was basically how are they sold out on Blackwell? So I'm going to just ask that question. We'll see whether we get an answer back. Not that surprising. I would actually have been dumbfounded if the DeepSeek and Alibaba stuff actually would have slowed investment, and certainly not in, you know, the quarter that is just being reported, because what's being reported, obviously a good portion of that spend and the orders in had already taken place. Really, the question now is how they guide for the rest of the year. Are they sold out on their high-end chips and so on? And then obviously any concerns about, you know, the demand pull that might be coming from, whether directly or indirectly, you know, from China, and might somehow be impacted by even more stringent export restrictions that the Trump administration is imposing over and above what the Biden administration did. Anyway, we'll get back to that in just a second, but Deckers has sold off quite considerably, and I just wanted to show you a couple figures here because I think this is rather interesting. So we're looking at a company that has had, you know, double-digit top-line growth, double-digit bottom-line growth consistently now for several years. And if you'll notice, so even if we assume that these numbers are a little bit optimistic, but we'll just take them at face value for the time being. So round numbers, stocks trading at $145, $6.70 a share in estimated earnings, 10% top line growth and 21.6 times forward. And compare that instead to Nike. And I'm really trying to get my arms around this one. So here you've obviously seen flat to declining top line growth, declining earnings, and this sucker is trading at 32.5 times fiscal 2026 estimates. That's the fiscal year that ends in May of 2026. Don't get it. Now, I noticed that there's an analyst at Jefferies, what is actually just taking a look. Let me just see if I can remember. Koenig, excuse me. So this guy, Randall Koenig, I'm sure he's a smart guy. Don't happen to know him. It's interesting because he's kind of taken the complete opposite point of view from me on this situation. He's got to sell on LULU, he's got to hold on Deckers, and he's got to buy on Nike. And I'm guessing, you know, there is something important that does happen on the sell side, and that is that sometimes it's really helpful to have, you know, the really heterodox view. The highest target price or the lowest. The person who's betting on the turnaround story. Everybody loves a good turnaround story, and such is the case here. And I have a feeling, you know, whether deliberately or not, whether, you know, this is what Randall's thinking about. But I have a hard time understanding why you would want to buy something on the hopes that they figure out what the problem is and begin to fix it and pay more for it in anticipation of that change than to buy at a lower turn those companies that are executing, that are expected to continue executing, and that have been for the last several years. And one final point, which I think is also kind of interesting, is that the former chairman, continues to sell Nike shares, and I think was selling, when the stock was lower. So kind of amusing to me that's the direction. And I kind of want to also illustrate that there are people that have very different viewpoints on the street. I think this is a very good example. We can see that Nike also has seen some meaningful moves higher over the course of the last several days, even as the S&P has struggled a bit. And just it's an issue of perspective. One person put it to me this way. He said, it seems that some sell-side analysts would rather shoot at one bird in the bush than have the two that they already hold. Really difficult for me to understand, but figured I'd throw that out there. Something to think about if you're looking at this. And for what it's worth, the guy that I was talking to about it, and he didn't mind if I happened to share this, but somebody I worked with, long, short, hedge, deep dive fundamental guy, I've known him effectively my entire adult life, but he's put that on as a pair. Nike versus Deckers, a long Deckers, short Nike as a pair. Something to think about. So let's then move on to Land's End, and that's where this whole conversation ultimately began. And I have a copy of the letter here that Eddie Lampert sent to management. And if you have any interest, by the way, I don't know, maybe we might be able to put this into the description. I'm going to see if that's actually possible. I'm going to put this. We'll add this link to the description. If it's, we may not be able to do it by the end of this live stream, but we'll throw it in there so you can take a look at this yourself. Worth doing, when you see this kind of news come out, you can go to the SEC Edgar website, and if they're a big holder, as Eddie Lampert has 55% of the company, they filed a 13D on this, and this is one of the exhibits. And it's arguably not that surprising that he would, the stock's been completely moribund now for years. So, presumably, and if he continues to hold it, then presumably he thinks that there is some untapped value. But let's just go back. And we can see that, this has not been a great performing stock at all. I think the market cap, like I said, is only a few $100 million at this point. I think it's $370 million, $665 million enterprise value. Now, he throws some pretty extraordinary figures on his take for the valuation of the business, and I don't know how clearly this can be seen. I'm going to blow this up a little bit, see if you can get a good look at it. So basically, right now the company's doing, $1.3, $1.4 billion in sales. He's in, one of the figures that doesn't quite jibe with what I'm seeing is that he works it out to an adjusted EBITDA in the neighborhood of $92 to $96 million that you can see here. He then has some ideas on how they could potentially grow the company. He sees that he seems to believe that they could grow the revenues 50% over the course of the next 5 years to $2.1 billion, that they could expand their margins by reducing their SG&A expense by a couple percent. And then, he extrapolates from all of that, throws a 10 to 15 times EBITDA multiple on it, and he gets to a valuation of about $5.6 billion. Now, that's essentially 10x what the company is currently worth, and substantially more if you're looking at it on an equity valuation basis, right? So if we just go back to our numbers that we were looking at here. So here's the, maybe some of you are intimately familiar with these concepts, and perhaps some of you are not, but I will just go over it just so that, so that everybody can sort of play along at home, if you will. So when he talks about a $5.6 billion value for the business, he's talking about the enterprise value in total, which is right now $665 million. Now, so that would be, in round numbers, an increase of $5 billion in the valuation of the business. And assuming they took on no incremental net debt to achieve the kinds of objectives that he's talking about, then effectively the increase of $5 billion in the valuation would accrue to the equity. So effectively he's saying, I think there's a potential 13.5 bagger here. So, 13, you guys can also do this math, but why not? We'll just do it together. We'll just call it $12 a share. So that's, we're looking at a number somewhere in the neighborhood of $160 a share or something is what he was suggesting this thing could be worth. I really struggle to come up with numbers like that. Why is that? A couple of reasons. This company has some other competitors. One of our producers who may be on right now, and I'll find out in my ear probably in a second if he is, he also does some contract work and might be doing some contract work for Land's End. So this is where this whole thing sort of stemmed from. We were looking into it a little bit more deeply. Yeah, Brad. So what were the other competitors here that you thought were? Genesco was one, I think, right? Yeah, Genesco was one. So this is a potential competitor. And Finish Line, which is now privately held. And that matters because Finish Line was acquired, and I went back and I took a look at that deal. And here you have a company that's already doing $2.4 billion in sales, and they've got $1 billion enterprise value. Their EBITDA is, 70 to 80 over the course of the next couple of years. And that's certainly not getting a 15 handle. And, anybody who's going to acquire these businesses, would normally be expecting to get some form of a deal, especially for a company that just hasn't really been doing a whole lot over the course of the last couple of years. So, yeah, the stock got a little bit of a pop off of that. There was an article that was put out where people were saying, could this thing go to 90? I think may have been Yahoo Finance or Business Insider said, can this stock go to 90? I don't know if any of you guys are looking at these kinds of things or if you follow that, but I have a really hard time coming up with the numbers that are being suggested here. This is very much pie in the sky, business planning kinds of numbers that are being thrown out there. That said, is there some potential upside? I suppose. The kinds of numbers that are being suggested here, and he actually also talks about a potential strategic acquirer. This is the other thing I just want to point out too, is that we're not in that neighborhood where there's a big short interest, but if that short interest should start to build, and then you've got all of this kind of deal chatter going on, who knows? There's a circumstance where the stock could potentially pop a little bit. But I just wanted to sort of throw a little bit of cold water on some of the things that got tossed around in terms of potential valuation for Land's End based on that commentary. I still think it's important to keep an eye on those things, of course, but yeah, that's really, really difficult to get to. Okay, so let's take some questions. Finn West, Aloha Mike, back in the U.S. for a spell. Good to tap into your live stream when the sun is out for change. Yeah, we're getting some nice weather here today, which is pleasant. So I'm very much enjoying the days getting a little bit longer and a little bit sunnier. We were getting rained out Cats and dogs over here for a while. Steve Garcia, hello. Awaiting NVIDIA results. Well, we've got them now. Bought several contracts of the Feb 28th, March 21, 118 put calendar. So, oh, actually, on this one, I don't have the real. So, where is NVIDIA right now? Let me get the after hours. Where are we? So, I'm seeing 129. So, that trade. Actually, wait a minute. Which calendar did you buy? March 21. I'm curious why. I'm curious what had you select the Marches, since there's no other catalyst that would capture. Usually, I mean, personally, I don't really care which expiration one sells, whether it's the one that expires the week of the event or thereafter, or maybe even 30, 40, 50 days after the event. I just prefer generally to get calendars where the longer dated option captures the subsequent event, because you won't get as impacted by the vol crush in that case. But, you know, that's fine. Actually, I think I may be able to just pull something up here, and maybe we can take a look at what the vol crush typically is for NVIDIA. So, let's see. So we're going to look at today's... Oh, wait a minute. All right. So we're going to go to NVIDIA. Should have... Is NVIDIA in here? I don't see NVIDIA. Yeah, let me see. I think, yeah, okay. We don't. I don't have it in that one. We'll take a look at that tool as well at some point, but maybe we can take a look at it here actually. That worked out nicely. So let's see. So what we're looking at here, if you have the Marches, we'll just call it 1 month. 1 month vol. I think that's probably as good a way to look at it as any. Let's just go back 8 quarters. So I'm just going to draw a line in here. I realize that this is a little bit fuzzy, but in general what you're looking at, so these humps are going to be earnings. 1, 2, 3. You know, so what you're looking at is 1 month vol is, you know, going to fall by, you know, something in the neighborhood of an average of these amounts as a function of the pre-earnings volatility. So we could, you know, take a look at and annotate some of these things and just say, okay, well, here it fell 40%, here, you know, in the ensuing days 34% there. Let's go over here, 34%. 32, kind of sensing a trend. 37, 38-ish. Yeah, so, I mean, basically what's going to happen is that all else equal, the value of those Marches are going to drop, and, you know, by about, the vol is going to go down by about, you know, 30 to 40%. So let's just take a look at it. It was the 118s. And by the way, I'm not trying to knock the trade too much. I just want us to think about things. The volatility for a longer dated, like a 100-day option, would not fall anywhere near as much. So here we're looking at the 118s. It's probably not actually 90 vol. Let's see what it really is. So that volatility is 70, looks like. So that's going to be in this neighborhood. So that gets you to $1.20. And oh yeah, I should probably take this up to, I don't know if it was just the March regulars, but yeah, we'll put the March regulars in there. 70 vol. So now we're going to get to, we'll call it 65% of that number. Why not? So put 45.5 in. So you've got an option that's, you know, $3.50 ish, right? And all else equal, you know, that sucker's going to lose, you know, it's a pretty good chunk, a couple of bucks. And now, granted, if the stock drifts down and it runs to that strike, that's a win. But, you know, you kind of want to, if you can, when you can, you want to grab the options that don't. And let's take a look at the Febs. Those 118s are about $1.50. So even these things are worthless as of tomorrow, most likely, unless the stock falls precipitously. But those are most likely a complete loss. So if you are in the trade, you know, for call it $2, it's tough to make money because the vol crush is going to impact those longer dated options, unless you really get down to that strike. So something to think about. The longer, when you get into a calendar that has multiple catalysts, you will see some vol crush, but it'll be much more muted, and that's an important element to think about. I think it's probably one of the reasons why people who advocate doing things like selling strangles, and they're looking for a balance between decay and a volatility decline, but not too much short gamma. Because if you're short options that expire in a day, like the Febs, you know, unless you own something longer dated, you know, you have a lot of gamma. That is to say that the amount of premium you collect relative to the risk and the change in the delta is going to be very sharp. So I hope that works out for you. Understand why you did it, but just something to think about. Try to make sure that you capture those extra events. Kirk Maisie, good afternoon, Mike. I was wondering about a speculative play in alt energy, NNE. So I'm familiar with NEE, Next Era. So let's take a look at this one. Okay, so this is a complete, what were these small mod? Oh, let's see here. These modular reactors. What is this? Portable, clean, proprietary reactor designs. Yeah, so this looks like, you may remember that a while back I had said that I thought that maybe an interesting way to get a play but not necessarily take so much of a speculative bet would be something like a Vistra Corp, which owns a piece of an SMR startup. And they also do decommissioning, recommissioning, and maintenance and construction work in the nuclear space. And I figured that they were going to benefit from a nuclear build-out. I like the small modular reactors, as I mentioned when I talked about that space. So if you're looking to make a play in that area without necessarily, you know, taking a flyer on a pre-revenue startup, that's a way to do it. Let's take a look, see what's going on the options side here. Looks like you're not alone. This thing's trading quite a lot, huh? So Feb 25 is what's on their event calendar. So nothing meaningful coming up. I wish I could advise you on this. I admittedly am not overly familiar. My tendency is to say, get somebody who has exposure to the space and also owns a little piece of the upside. That was my floor call. I'll endeavor, though, to take a closer look here. But, you know, these pre-revenue companies are pretty difficult. So let's see here. On credit spreads, where your max loss exceeds the credit received, which is common, I think that's pretty common. What is an appropriate profit target, and do you base it on the credit received or the max loss? So I look at this, the way I like to look at this is on a credit spread, you know, it would be my preference to be able to sell options without doing credit spreads, because I often feel like you're overpaying for that insurance on the wings. But really the gist of it is I'm interested in selling options where I think the expected value of the short side is less than how much I'm collecting. And let me see if I might actually be able to illustrate this. Let me see if I can do that. So I am going to see if give me a second here. Let's see what we want. Okay. Just going to illustrate this really quickly. So here we're looking at AMR. This is just the ticker that happened to be in it for what it's worth. Now, what these bands are, and I can't, it's a little washed out for me, so I don't know how clearly you guys can see this. What the orange bands represent is essentially and this is based not on the options premiums, okay? This is based on the historical behavior of this particular stock. The orange lines represent, the 90% threshold. That 90% of the time the stock is going to be within that boundary. That's all data going back 5 years. The green lines represent the 90% price trajectory. So 90% of the time it's inside of that through earnings. Now, it should make some sense that the green curves are going to be outside of the orange curves because stocks are more volatile when they report. Now, when you actually have a sense of both probability and magnitude, you can calculate the expected value of an option through some future date. And so that's really the first thing I think about. Is that value a positive number or a negative number? If it's not a positive number, then I have no interest in doing it at all. The next thing I like to think about is, okay, well, what is the yield that I'm getting based on equity risk, which you could think of as the price of the stock or the value of the strike, depending on the circumstances. So let's just take a look at, let's see if we can pick out something that's coming up. Work through it. Actually, what am I using this one? Pull up, where's my unusual whales? I'm sure I had this running somewhere else, so I'm probably now running God knows how many. But this is a good place for us to get started. So let's just take a look at the calendar, look at the earnings calendar. Let's pick something that's coming up. So, anything interesting in here that we can take a peek at? Oh, yeah, that's a good one. When we take a look at Vistra. I was actually just talking about Vistra, I think, on Fast Money yesterday. So Vistra, if you don't know, and for anybody who didn't see Fast Money yesterday, Vistra is one of the energy plays that people have sort of been piling into when they're thinking about the data center business, the AI play. So this is on the energy side. Constellation is another one of these. After the DeepSeek thing, the AI trade rolled over a little bit. That affected this space, but something else has been affecting this space as well. So the issue that is facing Vistra, and one of the reasons that you can see that the stock has actually really been hurt here going into the number, and you can see it has an above average implied move here as well. So, if you're in the utility space, you're in a regulated space. And PJM, so if you're familiar, PJM is basically a region of electricity distribution in the Mid-Atlantic and the Northeast. And PJM, it stood for Pennsylvania, Jersey, and Maryland. And different generating companies have different levels of exposure to PJM. Now, PJM holds an auction, and in that auction, there's some regulations that go into it, and that is governed by the Federal Energy Regulatory Commission, or FERC as it's known. So there's going to be both a meeting in June and then an auction in June. The issue that came up was that PJM sent a request to FERC in December, and what they were asking for were some changes to the must offer, which is the generative capacity that the participants in this have to make available as a part of that auction. The idea is that if you can increase the amount of available supply that is encompassed in that auction, then presumably you can help mitigate price increases. And that's one of the things that has hit them, because of course, as that's going to pressure potential future margins. So the expectation for Vistra, I think, was that their forward margins were going to be something like 11% versus 7% trailing. I'm going off of memory now. And that, of course, changes things dramatically. 400 basis points on 700 in terms of incremental margin, because you can't just build generative capacity out of nothing. I mean, it takes a while to build nuclear plants. So when you're talking about earnings growth, what you're really talking about is running at full capacity and what margins are you getting. And so that's one of the things that hit the stock. All right. So as we take a look at this, the question then is, what do we think the moves for Vistra could potentially be? So if I bring back my other charting application that I had here, and we stick this one in, and let's see, this was for the 28th, so is Vistra in here? What's the date today? Today's the 20, oh, it's the 26th. Maybe that's where I screwed up. So is Vistra in here? Let me guess, go. Oh, I see, because I've only got the 28th in here. All right. So we might be looking at this one a little bit too soon. But the gist of it is this. If we think that the move that is implied by options is too great, and that it's going to be closer to the historical earnings move rather than what the options market is currently implying. So you can see here, Vistra, the average move is 4%. Its implied move is 7.4%. So what that tells us is that when we take a look at, say, a strangle, and we'll just go out in time, and let's just go out a month, go out to March or something like that. We pick a 20 delta strangle, which has a 60% implied probability that the stock is not going to exceed the strike of the call or fall below the strike of the put. If we think implied volatility is too high, what was that? Someone was just trying to get in my ear. All right, well, I'll get back to that in just a second. Then this is actually overstating the probability that it's going to go above this, say, 177.5 strike, and it is overstating the probability that the stock is going to fall below this 125 strike, or say this 130 strike. Now, in terms of yield, I'm going to take these numbers here. So for that put, I'm going to say, let's say you could get it off at $4.35, so $4.35 over 130. So that is a standstill yield to maturity of about 3.35%, because the risk is that you have the stock put to you at 130. So it's not really risk on 148, it's risk on 130, because that's actually where you'd get long the stock. And that's 335 over the course of 23 days. Right? So 335, 23 divide, 360 times. So that's about 50% annualized. Okay? Now, if I think that this implied volatility right here is overstated by, call it 40%, we can actually see what we think the probability of that trade ending up in the money actually is relative to what the market is currently implying. And we can see that by just taking a look at the delta. So the delta right now is 23% out of all of 83. If I think that these are overstated by that 30% or so that I just suggested, so that's going to say this is going to be, rather than 83, it's going to be closer to 60. Watch the delta. 17%. Okay? And the expected value is, this difference here. So 220 versus, $4.50 or thereabouts. So I'm acknowledging that it could fall below that strike. I think the probability is lower than the options market is currently implying. And when I think about how much money I'm really expecting to make, what I'm saying is that 60% implied volatility is, we'll call it my reckoning of what fair value is. So I believe that this option is worth, call it 270 instead of 460. I'm not saying it's worth 0, but what I am saying is that my expected return is going to be, call it $1.80 for selling that. Because I'll be right more often than I'm wrong. The probability that it falls below that is well less than 50-50. I think it's 17%. The options market thinks it's 23%. But what I'm expecting to get for the risk I'm taking is, call it $1.80 over 130. So 180 over 130, that's 1.4%. And that works out to about 22% annualized return. I don't know if that's kind of where you could tell me whether that was the kind of thing you were looking for, but that's kind of the way I like to think about that. Now, oftentimes, as you guys know, when I'm trading vol, so I'm long vol in one place and short vol in another, instead of just being, say, naked short a put or short a strangle or something like that, it's, things get a little bit wonkier, we'll say. And, maybe at some point we'll get into that when we get into things like correlation and dispersion trading a little bit more, or just trading vol. But, yeah. So, FinWest, thank you, Snow, for delivering the goods. I guess, it's an interesting thing, right? So I don't think they actually reported profits, right? I think what was their number? So they reported $325 loss. Is that right? But, the important thing if you're long the stock, I guess, is that you are getting better results than the street expected. So this kind of goes back to that other conversation I was having about Nike and Deckers and things like that, which is that, there are going to be everybody's trying to handicap the future. So, it's not like you always have to have companies that are profitable, have demonstrated, lengthy track record of profitability in addition to the street's expectations of future growth and so on. And this is a good example of that. This is, again, trading on the future promise. So if you feel like you're getting to your chosen destination faster than anticipated, then you're going to get positive results like that. This is not a holding of mine, but glad it worked out for you. Nike brand reputation support. I'm assuming that's what you mean. Yeah, I mean, look, I think everybody kind of assumes that they're going to figure this one out. I think they figure that Elliott is going to, the guy spent his whole career at Nike before he left, when he was passed over for CEO originally. And, he helped see that he was a meaningful participant on many teams at Nike during its biggest periods of growth. So I think a lot of people are expecting that to resume. It's discomforting to me, though, when you have senior executives who continue to sell the stock and we're selling it, $10 lower than it is right now. Steve Garcia, I thought about going out longer to April. They do get more expensive the further out you go. The March long puts will crush a little. Yeah, like I said, we just worked through that. Actually, I mean, I'm assuming you meant you were long. You bought several contracts of the Feb 28 March 118 puts. So, yeah, I'm assuming that you are long the March 118 puts and short Feb. And it's true, but expensive, expensive is a relative thing, right? So I can appreciate that longer dated options premium will be many more dollars, but the risk that you're taking isn't necessarily as great, right? So there's a difference between price and value. Maybe we can think about it this way. Okay, Tesla has round-tripped to the November 5th level. Thoughts on a March 21, April 17, 285 put calendar. This is really, this is, I think I was talking about this also on Fest. I may have, not sure. I think I brought this up. This thing has blown through the 150 now. And so it's not entirely clear to me where our support level for this is at this point. And, the valuation, this is trading very much as a software and a data business and a FSD technology business and a robo-taxi business as much as it is a car business, because some of their sales numbers in Europe in particular are coming in pretty soft. I think we've gone over the first hockey stick of EV growth in the U.S. So the Model Y, I think, is the best short-term sales propellant for the company that they're going to have. But, yeah, so you are looking at a put calendar, the 285s. Yeah, not... well, let's take a look at it. Let's throw that one in and see what it looks like. And also, let's just hold a quick peek at the calendar here, see what's going on. So we have so if you get the Aprils, and they're reporting on the 23rd, the 17s don't capture that. The April 17s, I mean. So let's just take a look and see what we get. I would probably be more inclined to, again, push this calendar out a little bit further, but we'll see what this one looks like. And this is actually, it's also fine in the following sense, because neither capture an event, so there's not, a huge vol crush instance per se to be concerned about. So you were short the March 21s. And actually, you know what? We should have looked at the term structure. So for those interested, that's what that trade looks like. 45% probability of profit at least by this work, with a downside break even of 281.39. Let's just take a quick peek here, though. Because one of the reasons why this trade would be good, of course, is if we get an somewhat inverted term structure in the front, which we do have because of this big decline. So this is the other thing to think about. So we're going to ignore earnings altogether here, because neither expiration captures them. When volatility picks up, the front end volatility, the vol of vol, so how much implied volatility swings around, is greater for nearer dated options than it is for longer dated ones. Longer dated options as a dollar value will swing more for a 1 point move in implied volatility, but the moves are not as pronounced. And so what's happening here is that because the stock really fell off a cliff, near dated implied volatility shot up, as we can see. So what you're trying to take advantage of is the fact that this term structure wouldn't normally look like that. In fact, even a week ago, it didn't, right? And if we go back a month ago, let's see. There we are. Oh, no, I can't do that, because now we're going back and we're capturing earnings again. So let me go back to 2 weeks. 2 weeks ago. This. So the expectation is that volatility could come in, but what is going to come in more in implied vol terms is going to be this front part. So they have a lower vega, but they're likely to drop further. So yeah, that's all right. The other thing I like about it is that you have, you're sort of targeting a price level that it has sort of come back to, right? So this was a huge, basically parabolic run, and it's come back now. We're approaching the 200. So, if you think it's going to start to slow down its decline at the very least in this area, or level off or go sideways, then I like that trade. And you're capitalizing on that term structure element, which is that it'll shoot up like this when you get these kind of steep sell-offs, and then if things calm down, that vol will come down, and it'll be the front end that it will drop a little bit more. Okay. With your strangle swaps, what is the math you work with? Example, DELL, buying June options, selling a March 21 strangle. So the way so there's a couple things I like to look at. We can take a look at DELL. Things to think about. One, what does the term structure look like? Two, what is sort of mean volatility for the stock? Three, what are the upcoming catalysts? Four, what is the average vol crush that takes place? So, and then of course, outside of that, I'm going to start thinking about technical levels of support, resistance, and also what my assessment, as you guys know, I'm always interested in the fundamentals. Now, that's not a trading tool, but it matters to me. I can't really not look at it because that's where my background was when I was working at the hedge fund. We were a deep dive fundamental. So I always look at that first and then take the other things into consideration, usually not the other way around. And possibly to my detriment, because one of the things that does is if all you're ever doing is looking at the fundamentals rather than looking at, unusual technical activity. So for those of you who are starting by looking at breakouts or breakdowns, things of that nature, I encourage you to continue to do that, because if you're trying to trade in a short, in the short term, those are the things that are in many ways going to matter more, because I'm often just looking at financial statements. It may seem odd, but I'm maybe paying less attention to the immediate price action, and then I go into that when I start trying to construct the trade. So arguably, I'd be better at screening the universe for trading opportunities if I started the other way around, but it's just a habit. You can kind of see my workflow, so you kind of can get a sense of how I think about things. But so if we're looking at DELL, so here we can see the term structure. I'm just going to get rid of this. So that's what we have right now. So we have, an inverted term structure. Near dated vol is clearly pricing in a lot more activity. So the next thing we're going to take a look at is, when the events are going to take place. And this, of course, explains why the term structure looks the way it does, which is that the company is going to be reporting earnings tomorrow, implying about a 10% move. That is bigger than usual. So if I was looking at this, the next thing I would be interested in seeing is, okay, oh, you know what? I think I have this. Do I have it up? So where's my event variance comparison? This has got the wrong ticker in it. Bear with me. This is just something I was looking at yesterday. So we're going to put DELL in here. I've got a 7.2% implied move there. All right. So 30-day implied volatility. 61.6 is current. And this is the, is that, yeah, got too much data in here, so I have to go like this. Excuse me, I'm going to just cut this out. We're going to do this. We're going to insert a histogram, And what we're going to take a look at is where this 61.6, which if you're getting into a strangle swap is what you're selling, where that falls relative to the history. There we go. Yeah, we're going to do that. This obviously doesn't have anywhere near enough buckets, so let me just add a couple more bins. Let's put in 20. There we go. Now, unfortunately, because, you know, the company was publicly traded and then it was privately held and then it became publicly traded again. So where we are right now at 61 is right over here. Okay? So what we're looking at is 30-day implied volatility for DELL options before they report. And in the grand scheme of things, this is where we're at. Okay? And so now that would seem like, you know, we're not all the way up here, but this is above average. So you are if you're getting into a long strangle swap in DELL right now, you are going to be selling options that are, you know, pretty considerably above their average. What is their average? 46.2. This is 61.6. So I think that's, you know, the first thing that I would like to think about. The next thing I'm interested in is, okay, the longer term options that I'm going to be buying on that strangle swap, what kind of vol crush do those generally experience after earnings? And so we can take a look at that by saying, okay, now 6-month options is a little bit longer dated than you probably are going to buy, but we can get a sense of it here. And this is where we're at, right? Ooh. Okay, so these are also quite pricey, as we can see, on a relative basis. This is another way to look at it. So we can see the... that last thing I was showing, by the way, was context driven. In other words, the 40, whatever that number was, I think like 43 vol, implied vol, that was for 30-day options ahead of earnings. So that was in the context of earnings, not all time. This is now all-time data, but we can see that this is fairly expensive. So these are the kinds of drop-offs that I might anticipate. So let's just say that I think I'm going to get a vol crush similar to that one. So 15%. So then I can go and construct my strangle swap. And I'm just going to anticipate that I'm going to collect the money on the short side, and then I'm going to lose the vol crush on the long side. And see what that looks like. And I apologize because I think I have a lot of I'm going to just kill a bunch of these browser windows because it's slowing down my work. I'm nothing as bad as my wife. I looked at her computer once, and I think she had something like 100 browser windows open. So, and also we want to make sure of one other thing, which is that we want to make sure that we're going beyond the subsequent earnings, which is May 29th. Okay. That's the estimated, by the way. Just remember that. So that means I got to go out to June. So I'll buy June. And let's just say we'll use, and actually the way you normally do this, and I've got to come up, I have to add a short call and put, is that usually I would take the implied move on the short side. So go like that. And actually, the first thing I should probably do, so we're at 115. I can just see by looking at the strangle what that is. So the implied move is going to be the straddle, excuse me. So $15. So we can use the 130s up here. And we can use the 100s down here. This actually seems, this should add up to, yeah, that's probably pretty close to right. Okay, so the implied move it's going to be about 0.8% of the standard deviation and have an expected probability of profit of about 60% on the short side. So we're going to sell these, we're going to buy these, and it's going to look like this. Okay? Yeah, a decent trade, I think. And, you know, what went into my determination that I thought it was simply that I think that the implied move, you know, if you're selling options going into an event, first of all, in the general case, if you don't know anything, you probably shouldn't do it. When you do start selling options going into an event like earnings, you need to start thinking a little bit about the implied move and how that move fits into prior implied moves, as well as how much the stock has historically moved. And then, of course, there are other things that could be changing too. You know, you could take a company that was not levered, now it is. Think Royal Caribbean, Carnival Cruise. If you can't compare the pre-pandemic earnings moves to the post-pandemic earnings moves because the companies took on a lot of debt. And as they took on more debt, then, of course, the equity becomes more volatile. So, you know, understand that there's all these moving pieces. But, you know, if you don't have anything meaningful changing in that context, then the thing that you're looking for is how much is the implied move? Do I think it's going to move less than that amount? In a strangle swap situation, because you own longer dated vol, you know, you are insulated somewhat from that. Not completely. I mean, you can see that on the wings, you know, you do lose if you get a really big move in this case. But that's usually a pretty good buffer. I mean, take a look at this. I mean, your upside break even on this thing is 145-ish. You know, up $30. Your downside break even is, according to this, 93, 91-ish. It's actually slightly less because of the vol crush that'll happen on the long side, but it's not a bad, you know, there's not bad rules of thumb in there. Other things you can do too, by the way, is, you know, you can also use it on a delta basis. So you can just say, the one I'm selling is going to be delta neutral unless I'm skewing it one way or the other. So let's say I think I'm neutral to bearish going in, then I might adjust my strikes down. If I'm neutral to bullish going in, I might skew both strikes up a little bit. Right? So those are the minor adjustments that you can make. So you can take a little bit of delta there. But the other thing you can also do is sort of match deltas, and then you get into diagonal spreads on both wings. But yeah, as it happens, Dell's implied vols are a little on the juicy side. So that's positive. What is the best free site that provides the 90-day average option volume for any given ticker? The best free site that provides the 90-day average options volume. I don't actually know, since I don't use free sites. You know, look, not for nothing, but I'm not going to say that there isn't decent free information available out there. But what you are doing, chances are if you're watching this right now, and if you're looking at stuff like this, that's because you're risking capital. And I'm just going to offer that sometimes it's worth paying to get better data, more data, proprietary data, things like that, than just looking for free information. We've gotten into a habit. I get it, right? I'm always looking for information for free. Google this, Google that. You know, I put information into ChatGPT or Grok. We've grown accustomed to getting information for free. But sometimes the most valuable information when it comes to risking money trading is not available for free. So I'm not saying you can't find it. I don't use it. I would consider, if you're risking any decent amount of money, that having better tools is probably money well spent. And I will tell you, one of the things that I love about using unusual whales, for example, is that I've been finding that a lot of the information that I get traditionally from the Bloomberg, I'm getting from this thing instead now. And this thing is a fraction of the cost of a Bloomberg terminal. Bloomberg terminal outfitted with most real-time data, and mine actually is not pulling in real-time data at the moment because I get real-time data from some other sources. And it's annoying because when I was at the bank and things like that, of course I would have real-time data for everything, futures, you name it. And I think the full boat with all of that data was somewhere between $4,000 and $5,000 a month. I was just talking to a former colleague of mine. He just runs his own family office now. He's spending $4,000 a month on his Bloomberg, and he has gotten very used to the workflow. But the fact is, you can get really good information, and in some cases, information that is a better visual. I mean, look at this expected versus actual. We're now looking at DELL. Compare that to the SERP function, which I show you guys all the time in Bloomberg. I mean, you tell me which one gives you a better visual representation of what's going on. So this one tells me the implied move is 9.75%, and the average is 8, and then I've got a table that tells me what's going on. Or I can say, okay, over the last 8 quarters, here's the implied move, and here I can see all of the moves that actually took place, and I can look at that very easily for different periods. And the Bloomberg terminal is orders of magnitude more expensive than this. And also, you'll notice, I mean, I use options play all the time for just constructing trades. I'll use that for doing stuff on my phone. Someone at CNBC calls me up and says, oh, can you just tell me really quickly what's going on? Am I going onto the Bloomberg? Well, if I'm out running around, no. I'm going to go on to unusual whales. Or, if I want to quickly see what the price for a spread is and just as fast as I can enter it and get a quick look at what a call spread is or a put spread is, or, for example, that strangle swap, I'm going to use options play. And these things cost, less than 10% of the cost of Bloomberg, probably less than 10% to have both, frankly. I don't know what you get a 20% discount on unusual whales, by the way, if you click on our link, if you decide you want to do that. And I think it's 30% for options play, and you can decide whether that's important to you or not. But as far as free data is concerned, I'm sure there's some out there, but not necessarily the best approach. I'll look into that. I mean, maybe your brokerage platform. You probably don't pay for that, right? So if you have Interactive Brokers or Tasty, those guys are traders, by traders for traders. Interactive Brokers, exact same thing. So some of the platforms are actually quite good. I'm going to guess, so that's what I'll say. The best free source is going to be your self-directed brokerage platform. Just make sure you're on a good one. Otherwise, buy some tools that work for you at a price you can afford, and don't worry about it. That's my 2 cents on that. Okay, and whoa, I've chewed up way over an hour. So, anyway, let's just recap a little bit what we were talking about here. If you are interested in stocks that could have some kind of deals going on, look at Land's End because it's not a big company, and read what Eddie Lampert sent in. You can go to the SEC's Edgar website, you pull down the 13D, and the letter is going to be one of the 2 exhibits, I believe, that has. And then just read the letter. And I think, what's helpful about that is you get to think about how those guys think about the valuation of a business, or at least how they like to think about the valuation of a business when they're trying to convince somebody to buy it from them, because that's obviously what he's hoping to do. I think that the numbers that he's coming up with are pretty... Oh, yes, FinWest, excellent point. Tools that you pay for when you're trading, those are tax deductible, right? So, this is you're not paying that with after-tax dollars. So that's a valuable point as well. I think you should read that letter because it's informative about the way that people back of the napkin corporate valuations when the business is relatively simple, as Land's End is. That said, 15 times an EBITDA number, which is, based on a lot of optimistic assumptions in my view, and a $5 billion upside to the equity, I just don't see it. I don't see it when I look at Genesco. I don't look at it when I see, when I compare it to Finish Line, which was already, that's now private. It was acquired by another company, but they got a big turn. But if I applied those same numbers, is there a premium to Land's End? I suppose. Is it a $5 billion premium? Not by a long shot. But I think it's a very worthwhile exercise. For those who have watched names like Estee Lauder and Nike really outperform the S&P since the S&P sort of hit this recent bumpy patch, I would really encourage you, my 2 cents again, why switch off of things that are working and executing well and trading at 20 to 22 times forward earnings to buy something that is a turnaround tail at 32 times earnings that has been disappointing top and bottom line for several years in a row, where senior executives are still out there selling the stock on the brand recognition for Nike. I mean, I'm not saying that they'll never turn it around, but maybe we wait and see if they do start to turn around. Yeah, you won't get to buy the stock here if they do that. I want to make that point. But sometimes it's better not to try to catch the falling knife and try to pick the bottom. And say, oh, they'll definitely fix this. This is it. This is my big chance. I don't know about that. And I also don't think that this sort of weird flight to safety. I immediately thought of that Geico commercial when I saw that those stocks were taking off. Ones that have really been struggling because the companies that have been crushing it were suddenly getting sold. That's your running car. If you're in the horror movie, the running car is where you want to be, not behind the hanging chainsaws. I'll leave it at that. Thanks, as always, for watching. And tune in on Friday, 2 p.m. Eastern. We're going to be doing another one. Oh, and this is also interesting. If you're interested in crypto, I hope to do a live stream the following Friday at 2 with Dark Side of the Moon from Twitter. FinTech guy. I've known him for a very long time. Made tens of millions in Bitcoin himself. He's going to be setting up a hedge fund soon, and he has some really interesting things to say about it. He's well followed on Twitter. He's going to be joining us a week from Friday when we do that live stream. So be sure to tune in for that one too. Thanks for watching.